By looking at the futures contract, if we're going to be trading Forex, okay, it's really important that you know that you can get a lot of insight just by studying the underlying futures price. So if we're going to be looking at the Australian USD pair as our case study, we're going to be looking at how influential the study of just the futures contract alone, how that's paramount in understanding how that moves right into and segues beautifully into trading in the foreign exchange market. If you're a futures trader, you've never considered what the foreign exchange market's doing. Or if you're a Forex trader and you've never considered what the underlying futures contract is doing, vice versa. It's imperative that you understand what they're both doing. To get a complete picture, you want to be looking at both. Now, obviously, right away, one's going to assume, well, it should be the obvious. It should be the same thing because the Australian is leading the pair, Aussie versus the dollar. So therefore, the Australian underlying futures contract should be, in fact, the same thing we see in the foreign exchange market. And by far and large, that's true. But there's certain data points that you cannot get by looking at the foreign exchange market. There's simply no way of getting that because foreign exchange doesn't give you volume. It doesn't give you accurate volume like you can get volume from the underlying futures contract. How would we go about looking at where the IPDA data ranges are? And if we're looking at Australian dollar, the most recent market shift, okay, in the last 3 months occurred back in November. We can clearly see that there was a major market shift in November 2016. Now, what that does, it gives us a great deal of insight. We can't take a time capsule, travel back in time, okay, and be back in November and go short there, but we can use the information that our daily charts are telling us there. That means there was a great deal of displacement by the large players or smart money. When we see that in November, what we're seeing here is the underlying futures contract of the Australian dollar has a market shift right there. That's a quarterly market shift. Over the last 3 to 6 months, that's the most obvious one. You can clearly see it. That's what you're looking for. Every 3 months, there's going to be something like this occurring. It could be a sell-off, creating a high, or it could be a low where it starts to rally. The IPDA data range, okay, you have a 20-day look back and cast forward range. You have a 40-day look back and cast forward range. And then you have a 60-day look back and cast forward range. What I'm suggesting to you is if you are looking at price and you see for instance, you have a market structure shift here and the quarterly shift occurs in November. That means that now the market is in a sell profile from that point until it gets to a level of significant counter direction. What would cause it to change direction or consolidate? That's the other thing. That's the vague gray area in the analysis. Sometimes you won't see a clear retracement or correction opposite direction. For instance, it's been going down November. It could have very easily been consolidating here going into January, okay, and into February. It doesn't need to be a counter trend move like we're seeing unfold here since the last week of December. It can be a consolidation. So back in November, we see that there's a high made. What's really going on? That low here is broken. So we have a shift in market structure and it breaks lower. We know that. We can see it because it's taken out an area of equal highs and we pierced above that, taking out the buy stop liquidity pool, and that's seen here. That was the basis and the framework around what caused the market structure shift. That quarterly effect comes in to operation at that moment, where our eyes go immediately back to November because you can clearly see it. When you see that and you delineate that on your chart, what you're doing is you're now identifying the beginning of November. So you have to have a basis point. Where is it? Where did it all begin? Because if you don't get yourself in sync with what IPDA most recently did, and IPDA is the Interbank Price Delivery Algorithm, that's for your notes again, you're going to delineate where the most obvious one in the last 3 months has been. Then you're going to cast out 20 days, go forward from the beginning of the month that market structure shift or quarterly shift takes place. You're going to count out 20 days. Now, it may not even be 20 days. You may look at the chart and say, hey, this is an obvious one right here. Something's really going on. If you do that, you're really doing too much anticipation. You got to go back to the most obvious one, and it may require you going back 3 months. But find the most recent one where the market structure has shifted and there was a move that took place that was obvious, bullish or bearish. And it's really easy. If you just divide your daily chart into quarters, Like put a line on March, put a line on June and September, December, and just keep doing that. Your eye will go right to where these quarterly shifts are happening. They're not going to always occur on those months. There's a little bit of gray area, which is the reason why we have a look back and a cast forward. The IPDA data range, okay, what it's really doing is it's highlighting you as the trader. You're going to try to mimic what this algorithm's doing. It's looking for the liquidity in the range of 60 days in the past. Where is the sell stops in the last 60 days? Where are the buy stops in the last 60 days? Where are the fair value gaps? Where's the price gaps that price has not been efficiently delivered in the last 60 days? Where are the liquidity voids where price has only been delivered on the upside, where it has to come back down to efficiently deliver price and balance it out by going back down and closing in that range? Optimal trade entries, that's where that comes from. Where are the equilibrium price points? Does it have to return back to equilibrium? Did we get too far ahead of ourselves? Did we extend too far? Do we have to come back and retrace minor retracement before we see the next leg lower? By looking at the market structure shift that takes place in this November time period, we are in essence saying that this is a quarterly shift. Therefore, because it's a daily chart, this is going to give us insight about what the market should do on a 3-month timeline, as much as 6 months. But I like to just remind you that I'm only really looking for about 3 months time horizon, that far out. I don't like to look beyond that. There's been many times I can show you in journals where I had it right, but just because I had it right doesn't mean I was executing on every trade. But many times I'm really accurate in about 4 to 6 weeks time horizon, and it's about the half-life of a 3-month cycle. But these ideas are the same. So how can an algorithm or a computer, we'll just say it like this, how can a computer program know where everyone's stop is? It has to have a range of data. Now, just because we have the numbers of price, the value of price, okay, they have to have a look back period. The look back period is 20 days, 40 days, and 60 days. And what you're doing is and this is what I want you to do, go back through your charts and don't just look at the Australian dollar. Look at every currency pair. Look at every commodity. Look at individual stocks. Look at indices. And you'll see quickly by studying this, it will become quickly clear that there's no randomness to it. There's a specific pattern that this thing does all the time. If you look back 60 days in the past, what was the highest high in the last 60 days? There's going to be buy stops above that high. What's the lowest low in the last 60 days? There's going to be sell stops below that low. In the last 40 days, what was the last highest high and what was the last lowest low? Looking back in the range to the left from that November red line that we're delineating in November, where are the stops below and above those highs inside of the range of 20 days, 40 days, and 60 days? Well, what happens if there's a low that's really, really obvious that's just outside the range of 60 days? That's the farthest extreme. That's when the open float will move aggressively and go outside that normal parameter of 60 days, and you'll see that big run. The market will jump and skip right down into that old low that's just outside that 60-day range. How do you know when it's going to be an explosive move, Michael? When you have that scenario. If in the last 60 days, if they've already ran out the stops below and low in the last 60 days, or above an old high in the last 60 days, and there is a larger, higher high or lower low where the stops will be resting above or below respectively, then you know there's going to be a big run on price and they're going to run for that liquidity because that's the only other thing that's left. The large funds have their orders above and below these old highs and lows. If there isn't anything that hasn't been traded to in the last 60 days, if everything's been wiped out above and below the marketplace, in other words, the open float, all the buy stops above old highs and all the sell stops below old lows in the last 60 days during your look back, in other words, everything to the left of that November vertical line, that red line, if everything's been cleaned out above and below the highs and lows, there's no more buy stops, there's no more sell stops, it has to create a new expansion. So you have to identify what the next high and low outside that range of 60 days looking back where that is. And that's going to tell you where they're going to draw price on this daily time frame. It's more confirmed when you start applying it to the weekly chart and the monthly chart, because you'll start seeing things align where that old low that's just outside of the last 60 days looking back, there's an old low that may not be on this chart here. I don't know. I'm just giving you a hypothetical example. if there's an old low that's just outside the realm of September in this example here, say maybe there's August, there's a significant lower low, the market's going to reach for that. There may be a high that's just outside the September boundary in August. They may have turned around here and they make a run for that. That's what you would be noting, and you're going to look for price to be drawn to one of those two price points, and you look for evidences that that institutional order flow is going that direction. Then you know where it's going. It gives you directional bias because of the higher time frame nature of this daily chart and weekly and monthly. So what we have here, this is the look forward, okay, or cast forward of November. This is 20 days out from the 1st of November. So we have 20 days here. Inside of that 20-day range, there's going to be a significant setup that you can use for your trading. It's moving up into the old low that was formed in October. It goes into consolidation. Well, here we have a condition where the market didn't create any significant shift, but it starts to move in consolidation. Then you count forward, okay, from here, that's the 20th. So you can go from the beginning of November to the 20th. Yes, there was a price swing, but using the information, the next stage would be 40 days out from that price point of November beginning. We have here, that is your 40-day lookout or cast forward. And you're looking for, again, a potential major shift quarterly. It can happen at that point. Now, it didn't give you the lowest low because if you go back to the left, two daily candles or bars, the last down right here, this down candle, that was the actual low. We had a small little range in here, and then we came down and hit this level here at 71.50. That's the 40 days out from the beginning of November, framed on the quarterly shift that took place here. So we're anticipating a potential change in the direction, okay, 20, 40, or 60 days out. But that's the range. It's not always going to do like what you're seeing here, where it's almost calling the very day it moves and makes the change. You're allowing your study to say, okay, the price is going to move about 20 days, and then we could see something. If it doesn't happen in 20 days, okay, well, in the next 20 days, up to 40 days from where the market structure last shifted here quarterly, then we're going to anticipate in the realm of the next 20 days, it may happen. So you have to be looking for signs that it's going to happen. If you don't do these things, you're going to marry the idea that the market's going to keep on going lower and never turn around. It doesn't do that. Markets don't trade in straight lines. So if we see here on this day here, this is 40 days out from the beginning of November. Very significant price move occurred from that price, 71.50. One of the things I learned when I was an indicator-based trader, I liked stochastic. I liked Larry Williams' accumulation distribution. I liked his Williams percent R. And the reason why I liked his Williams percent R is because it has an uncanny ability to be one day before. When I looked at the percent R, what that did, it gave me many times the day before the real oversold condition would happen. For instance, if the oversold condition existed in Williams percent R, today, that means tomorrow it's probably still likely to go down just a little bit more, but that's going to be the buy day. That's the very low low. Well, that same phenomenon sometimes occurs with these ranges. 20 days out, you may get if it doesn't turn, it may happen on the 21st day, or it may occur on the 19th day when it does occur. But that's not what you're relying on. So it's important that while that may have magic in your chart sometimes, you may see it happen. It might do the very thing of turning on the 20th day or the 40th day or the 60th day. I'm not telling you that the market turns every 20 days, every 40 days, and every 60 days, but it can and will sometimes do that. What we're looking for is these quarterly shifts to take place. Once we identify one, there's our beginning point, okay? But you have to roll back to the beginning of that month it occurs in. It occurred in the second week of the month of November. So we're calibrated. Now we can start going forward until we see a equal or counterparty to that move going lower. It has to be a significant retracement or correction or reversal. It's indicating that here, the last week of December. Why is it doing that? Because we've taken out December's high. You see that? We're trading at a level where if this was continuously bearish, it shouldn't be where it's at right now today, okay? But my point in drawing your attention to the 40-day is it was not the 40th, it wasn't the fact that it made the lowest low and turned on that day, but look at the low in proximity to the lowest low that was formed here. Inside, this day here was inside the range of 40 days back to this price point here. So from this level, looking at the first day of November, casting forward 40 days, this whole turning point right here could have happened any time in the last 40 days. because inside that 40 days, just like when we look back for 40 days and look for the low for sell stops and we look for the high for the buy stops, in this range here, what is this? That's a low. Below that low is going to be what? Sell stops. Yes, we moved about 150 pips or so below that, but we came to a level of 7150. That's not random. 7150 is a significant level. It's a mid-figure level, and it's happening at a time when inside of 40 days, the IPDA data range is going to be looking to do something. It has to do something. Every 3 months, price is going to be pushed around. It's going to be drawn to a level, or it's going to repel from a level. It's seeking large fund liquidity. Now, longer term, where we're talking about monthly and yearly moves, they are all driven by real fundamental things like interest rates. But every quarter, there's going to be a ebb and flow that takes place, a rally and a decline. When this occurs, that's all short-term in nature. When you look at long-term trends that go for 5 years or 10 years, 3 months is nothing. That's like a 5-minute chart on the scheme of a weekly chart. It doesn't mean anything. There's no significance to it at all. Long-term macro fundamentals, okay, are not impacted by 3-month cycles. They're not. They can be used to get in sync with long-term macro fundamentals, but the only fundamentals you're going to get from me is interest rates. If we know at this point here, casting 40 days forward, we can have a vertical line right here on our charts. You got to count this day as day 1. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. Okay, so 20 is basically the last day before you get to December. So the second to the last day in November is 20 days back. What was the highest high formed in that range? It's going to be mid-December, where it made those equal highs. So there's going to be what's resting above that? Buy stops. So what is the IPDA algorithm going to do? It's going to seek that liquidity. It's going to go up there and take that. Which high should I look for, Michael? That one. Looking back from this point here, because we know it from this point here, casting forward 40 days, okay? Going back 40 days, well, that's going to be in the range that's delineated here with this line that we've already shown. This is the low. Is there any significance about that low? Well, I'll counsel you to go into your 4-hour, 1 hour, and 15-minute time frame and put up 7,300 on your Aussie dollar and see what you see. There's nothing random about this stuff, folks. That low is 40 days inside the 40-day range. Okay, that is a significant turning point. It's not the very lowest low, but you can see that the low forms 2 days before that. And then we have a market structure shift, and the market starts to go opposite to what has been put in place in November. You can now also, from that price point there, by having a vertical line on the arrowed daily range, you can now start counting forward 20 days, 40 days, 60 days, until you see an obvious shift quarterly. There was a major structure shift, okay? It could be bullish or bearish, whatever one it happens. It doesn't make it. You're not trying to forecast that. All you're doing is anticipating another significant move in price on a daily chart, and it happens every 3 months. But the point is the IPDA data ranges give you a means of looking back 20, 40, and 60 days from specific days and specific price points, because then you'll know what stops they're going to be reaching for above an old high and below an old low. It's not just, well, I'm looking for the most recent obvious high and low. No. It's not like that at all. You got to look back in a range of 20, 40, and 60. And then if all those levels have been cleared out, then you got to look outside that range. Then you know you're getting ready to see a big move. And if it has these characteristics, then you know you're going to see a larger move higher or lower based on what those highs and lows would be outside the most recent 60-day look back. All right, so this is the Australian dollar. Here's that 70.50 level, okay, and why that's significant. Here we have a old low back in February of 2016. We have a last down candle, but that last down candle has a range in it. Okay, let me show you again. This is what it looks like, that wick right in here, right here. Look at that price movement up right before the it's the last week of February, the big green candle right there. We know that prior to that, we saw the down close in that explosive range higher. That high is going to be significant. It's going to be sensitive, okay? But all the way down into the opening of that weekly range. Also, notice that this last down candle here, right before this big move up in the last week of May of 2016, that last red candle, that was the bullish order block as well. So we have a big range to work within. Then going into the latter portions of 2016, the last down candle in December, that would be a bullish order block as well. Looking at the high and the open on that candle would give you significant price points to go forward as well. But look what happens when price hits this 71.50 level. It's been down here before, and they repelled aggressively away from that. Fundamentally, must be something to it. I don't know what it is, but on a weekly chart, we're going to be using old highs and old lows. And if those old highs and old lows had significant buying and selling pressures, that's evidenced, and you can see it here, we have to be mindful of that. And you can see that they have, in fact, traded down there. We tapped it 2 times on a weekly basis and then moved out. Once we moved out away from that level, you see that they're going to be looking to do what? They're going to be trading above these candles' bodies, and the wicks are next, and we could potentially trade up into this last up candle in the last week of October of 2016. That's where the bearish order block is. So we have a range that potentially could take us up into 75.70 to 75.80 still for Australian dollar. Let's go back into the daily on Australian dollar, and I want you to take a look at this chart for a moment. Stare at this for a second. Tell me what you see. Okay, this is the March contract for the Australian futures market. It's going to basically do the same thing our Australian dollar pair does in Forex, but what you're seeing here cannot be seen in trading Forex. The fact that open interest is the most misunderstood data point in trading is a wonderful opportunity for you as a trader. How do we know when the banks, smart money, are actually going in and buying? If we know that there's a likelihood that 71.50 on Aussie dollar is potentially bullish, what evidence is there that there is in fact smart money buying it? Well, inside that blue shaded area in here, every 3 months this occurs. Write this down in your notepad. Where you're at a support level, a major higher time frame support level, if you see an expectation that the price should be bullish, we have been trading lower and we hit the level like we're seeing here at 71.50. As let me go back one more time to show you the weekly chart. There's that 71.50 level down here. We've been there before in May. Okay, so look at that level here. You can see that 71.50 has been hit perfectly. It nails it, okay, and then it runs away. As price hit it, this purple line in here, I want you to look at what was going on. As price was dropping down, okay, all through this market structure shift in November, what's happening here? Yes, price is repricing, going lower. It's allowing bank level traders to be short and capitalize on that move. But also, open interest is also declining. Why is that happening? Why is open interest declining when this move's dropping down? What significance is that? If the market is in consolidation all through here, all between 77 and 74.50 for August, September, and October, price was in a big trading range. It's in consolidation. Then in November, it creates a false breakout above 77 big figure and rejects and trades lower. Open interest is taught that as long as a trend is going up or down and you see open interest increasing as the trend goes, that's a healthy trend. That works for bull markets. Doesn't work for down markets. That's a misnomer. That's misinformation. Larry Williams says when open interest drops while you're in consolidation, we're in consolidation all through August, September, and October, price drops down in here, we have a big drop in open interest. Open interest is the total open longs and shorts that are in the marketplace right now. If the central bank is the storehouse for price, it's their currency, it's their commodity. If you are trying to buy currency, it has to be made available to you, and it's going to come from a bank. If this would have been gold, okay, the commodity is gold. There's a provider or a liquidity provider of gold. Okay, you have to buy up this position or assume a position in gold. Well, for Australian dollar, if you're buying that currency, it has to come from somewhere. It comes from the bank. So if they are the liquidity provider for the price of Australian dollar, the Central Bank of Australia, if that bank is providing you the basis of the valuation on Australian dollars, they are essentially doing what? They're the counterparty to all the large funds. Not always, not 100%, because you have all kinds of smaller entities and institutions that could take the other side of other positions. But for the most part, view open interest as every trade that the central bank is providing counterparty to. basically what a small brokerage firm would do with their own clients. They are the liquidity provider. Well, the central bank is the liquidity provider for Australian dollar. So if we see open interest increasing, what does that mean? That means the central bank is it's taking on risk. It's providing liquidity for buyers of Australian dollar. If open interest has a 15% or more drop or change lower, like it does here, this is a very significant drop. While price is sideways, this is bullish, because what this is doing is every time open interest increases, it's indicating that they have now provided liquidity for a buyer. If they're not trying to provide liquidity for a buyer and they're trying to reduce their holding or exposure, that means that they're not doing what? To offer liquidity to a buyer, they have to be a seller. Open interest reflects the selling side of a provider of liquidity. If this open interest declines aggressively like this, that's indicating they do not want to hold the heavy short position they would be having by being a provider for those that want to buy Australian dollar. You see it rally then. But look carefully. The extended trading range is months long. What's going on that whole time? From this point here, they start building in positions. They're selling this thing as it's creating higher highs. It's coming back. They're selling more of it here, and they're selling more of it here. Every peak in the open interest from the low it creates here, every peak in it is a high. They sold more here. They sold more here, right at this high. They sold the most right there. They're selling into that rally. You don't get that from Larry Williams' book. You do get him saying open interest increases. We're in bearish markets, and if we're in a consolidation, it tells you if we see open interest increasing in a consolidation, that means that the open interest is reflecting heavy net selling on the central bank level. That's how I'm viewing it for currency trading. But what he taught in his book was the commercial traders, the large commercial users or producers of a commodity, they're actually building in heavy short positions. What I learned was by looking at open interest and matching up the highs to the peaks in open interest, you can actually see where they did their sell programs. That's a sell. They're selling it here. And in the very highest peak, they sold it there. Now, think about it. If they sold it there, and then we do have a market structure shift here, are they going to hold on to their short positions if they're naturally a hedger? Open interest is going to, by natural order of things, reduce as it's going lower, because what are they doing? They're covering those short positions they built in here. That's what's happening. All through this process of going lower, open interest is declining. You don't get that taught in textbooks. It's showing you that they are, in fact, in a sell program, and they're profit taking. As it's going lower, open interest is going to decline. Then we hit a level like this, major support. Are they going to want to hold on to a heavy net short position by offering liquidity to the buyers? No way. How do they offset that? They do rapid price declines that knocks the desire for buyers to want to move away and get out of their way, because they don't want to be a provider. And by providing the sell side to buyers, they don't want that risk. And that's why they do these massive sell-offs in price. You see these big moves that jump down to specific levels, and they just keep going lower and lower and lower. They do that to take away and control sentiment on the near term. They know buyers are going to come in, so they have to reset and drop down quick. Boom, they reset. They take all their interest in being a sell-side liquidity provider and drop it down to its lowest point. Why are they doing that? Because now their exposure is not here. Their exposure starts down here. And they go back to that same cycle. Now everybody's starting to buy, and they will provide that liquidity because they've already profited down here from back here, and back here, all in the last week of September, the midpoint of October, and the second week of November, where they sold and built in their bearish positions. The telltale sign is inside that support level at 7150, dovetailing this with IPDA data ranges and quarterly shifts, we know that this is most likely going to occur. But the mechanics behind it all is that 7150 is support. Price on the weekly charts bounced there before. We're in the low end of the range for the weekly, the lowest point, which has been in a long period of time. Go back to your weekly chart that I showed here in your notes, and you'll see that that's the lowest it's been in recent time in the weekly chart. So therefore, it would be reasonable to expect to see some bounce at 7150. But I'm drawing your attention into that little area in December. It's a massive decline in open interest right there. That purple line, when it tanked, went low real quick like that, that's the central bank getting rid of any of their remaining short position. So now they're done. They completed their sell program. First week of November, mid part of December. So now they're ready. They're prepared for buyers to come in. They have reset themselves. There's no exposure on the upside, okay, against them by holding heavy shorts. So now they can start offering that liquidity from the low end because they made their book. All right, so this is what we've seen price do. Here's that 40-day cast forward day. That's the very day. And this is that down candle or down open, high, low, close candle, that small little one. And then here's the last one, or the 40-day look forward from the 1st of November. Price goes higher from there, creates a down candle. Price moves above that candle here. This becomes a bullish order block, so if price was to ever come back down, we could be a buyer there. I said we'd like to see some bullishness on this candle here because we're on the left side of the curve. This is all the sell side. Now, if they're going to be bullish, you're going to go look over here at every down candle. There should be some bullishness in here. We saw some of that. They have a down candle here. If we had a retracement, I would like to see it price come back down here. I would be a buyer. That was a potential scenario that could have unfolded. If it didn't and we blew out the high of this candle, this down candle is going to be the new bullish order block. So its high comes in at 73.50. Price comes down, hits it here yesterday, finds some sensitivity there, and expands up and closes in the range. So the things you're learning is completely diametrically opposed to those things that you learn in the retail world. And it's like that because we have to capitalize on those ideas because those things permeate large fund trading. Where the buy stops, where the sell stops, it's the same way. Human nature is going to repeat itself. Over time, price will agree on a level that's arrived at what IPDA is seeking. Last 60 days, where's the high and the low? Last 40 days, where's the high and the low? Last 20 days, where's the high and the low? That's where your liquidity pools are. Okay, last 20 days, where is the gaps? Where are the gaps in the last 40 days? Where's the gaps in the last 60 days? That's where all your fair value levels are. Think about it. Where's the consolidations in the last 20 days, the last 40 days, and the last 60 days? That's where your equilibrium price points are going to be. When the market isn't going to move, it's going to gravitate and hang at those levels. When you see me say, I'm not doing anything today, the market's going to be sideways. And you're all like, well, how did you know that? How to use the data ranges tells you what you should be doing. Should you be expecting range expansion on the upside? Should you be expecting range expansion on the downside? That is directional bias. Are you bullish today or are you bearish today? If you are not in a range where it's going to expand and you're hanging around equilibrium in the last 20 days, the last 40 days, and the last 60 days, in other words, what's that look like? If you go back 60 days and you see where the price has made a small little trading range, divide that range in half. That's equilibrium. If your price right now, today, if it's just hanging around and dollar index is not trying to move, it's probably going to be a Z day. That means it's going to go up a little bit, down a little bit, and hang around the middle of the range until it gets some kind of manipulation. What's going to cause that? High impact news. It's all time and price. Time is date on the higher time frame. It's not time of day, it's date, calendar days. And they're calendar days that the markets trade. So if we know there's a range of 20, 40, and 60 days that the algorithm will look back, then you know what high and low you need to be focusing on. If market structure is bearish, what does that tell you? Where's the low in the last 20 days? Where's the low in the last 40 days? Where's the low in the last 60 days? That's where it's going to be reaching for. It's looking for that sell side liquidity below those lows. What happens if it has two lower lows that haven't been traded to? And it trades down below the one in the last 20 days, it takes that low out. And there's a lower low 60 days in that range, 60 days back, there's a low, and you know that it's possibly going to go down there. But say it doesn't go down there, and it rejects, and it breaks market structure bullishly. What does that tell you? You have a quarterly shift. Now it's bullish. Start finding the highs in the last 20 days, the last 40 days, and the last 60 days, and you'll know what IPDA is doing. It's going to draw a price up to them. What you learned today was the real mechanics of what open interest does. It gives you the X-ray view of what the real smart money activity is. Are they really buying? Because if they're really buying, they're going to dump open interest, and it's going to drop 15% or more, and it's going to happen at a key support level. If it's going to sell off and start going lower, and if that was a real turtle soup sell, then that means prior to that turtle soup sell, there should have been a massive increase over time with that open interest going up. Because open interest, high open interest, indicates them offering the sell side. They're only going to take part of that if they know eventually they're going to be able to sell that position off with price being going lower. That's the only time open interest is going to go up. And they can do this on long-term trends, but it will shift every quarter. They have to fund themselves for allowing the holding of that risk. Every 3 months, it's there. And that's how they pay themselves for holding on to that risk, offering the liquidity for the sell side of it, providing the means for buyers to buy currency, they will do quarterly shifts, and you'll see evidence of that in open interest.